Great. Well, thanks very much for everyone turning up to this conference today and giving me the chance to present to you. Today I'm going to talk a bit about sort of what I do at Fidelity, but also by starting to talk a bit about just why I think contrarian investing is a very valuable thing to be able to do, and I think particularly in today's volatile and uncertain world that there really is opportunity in this type of investing. And I think over the longer term you can see real capital growth from this type of investment opportunity. So the presentation is very much structured into two parts. First of all, talking about the opportunity in uncertainty and why I think contrarian investing works, and then going on to talk a bit about how I actually enact that and how I run the Fidelity Special Situations Fund, and how I very much continue the strong heritage that we have at Fidelity on this product, which has been going since 1979, and why I think this is a great product for long-term investment. So we're going to start with an experiment which really talks about sort of why I think there is opportunity in uncertainty, and talk about some of the psychological and structural factors for why this really works. So do bear with me if this seems a little bit abstract to start with. So this slide deals with an experiment that was done in the 1980s by some Nobel Prize winning psychologists on a reasonably large survey sample, and it goes something like this. So the hypothetical situation is, I give you £30, no strings attached, you can take that to the shops, spend how you want. But then I complicate things a little bit. So instead of just giving you the certain £30, I offer you another option. So you can either A, keep the £30, no problems, or B, you can take a gamble with that £30. And the outcome of that is a 20% chance that you lose the £30, and then an 80% chance that you win another £15. So just with a quick straw poll of the well-informed audience today, who would choose option A? Yeah, very small. Who would choose option B? Yeah, so I thought that might happen. The good news is that this was a large survey and exactly the opposite happened. So effectively, why does this happen? And this is a well-known sort of loss aversion. So clearly, investors or people in the population as a whole prefer certain outcomes. So the human brain much prefers certainty rather than uncertainty. And so obviously with a well-informed audience like today, and especially as I'm talking about uncertainty, can clearly see that option B is the superior option, because the expected outcome of that is 20% higher than you see in option A. But when you look at this individual idea amongst a large survey of people tend to go for the certain option. And this is why I think the opportunity comes in investing. If you go for something that looks very certain, your expected outcome is likely to be much lower than if you are willing to embrace uncertainty. And I think that's very much what you do in contrarian investing, effectively not going with the herd and actually going against that and looking for things that other people aren't looking at. Now, if you take that down to an example more in line with the stock market, so moving away a little bit from these abstracts, to talk about sort of why investing in good companies may not actually be a great idea, you can see that if you invest in a great company where lots of other investors are interested, the products look great, the CEO is regarded as a great manager, and the company has done well historically, if that just continues, then you're unlikely to make very much money because the expectations are already baked into the stock price. The issue is if something goes wrong at that company and those high expectations are not met, there can often be a stampede for the exit as investors change their mind, and you can see very significant downside. And therefore, while the company may still be a great company, this has turned out to be a very poor investment. On the other hand, if you're buying unloved companies that other people are not interested in, where things are maybe going wrong, if that continues to be the case, you're unlikely to lose much money. However, if things change and things improve in the company, this is where you can make very substantial returns as other investors start to look at this company, and a lot of those investors try to buy. And this is very much what we're trying to do in special situations, buy companies that have a current negative perception, but where there might be that positive change, and get other investors interested in the company. So if we take that on to look at the special situations fund itself, sort of how do I enact these principles, and how do I work this across a portfolio? So first of all, when I look for investments in the fund, I very much think about the downside first. So I very much want to invest with a margin of safety, and think about sort of how much of investors' initial money could I potentially lose in each investment. And I think it's very important to look at this first, rather than thinking for the potential of gain. So everything in the fund always has an assessment of its downside first. And how do I do that? So there's a number of different things that I look at. First of all, I'm very aware of what market expectations are. I like to see stocks that have underperformed, where you've seen the exit of investors, people selling out. But then importantly, I need to look at the long-term valuations. Is this a cheap company versus history? Or is it still expensive even though it may have been underperforming? And then very importantly, balance sheets of companies are extremely important. Companies that have high debt loads, high leverage, very volatile business models, you can potentially lose an awful lot of money on those companies. And so a strong, thorough understanding of the balance sheet of companies is really key to this process. Once we've then thought about sort of the valuation of the company and some of the more sort of financial and spreadsheet-based metrics, we then go on to think about potential for future change. And there's two key types of change we look for, either an internal change or an external change. An internal change is by far and away probably the most common in the portfolio. I particularly like to see new management teams coming into companies because it's much easier to change things in a company if you weren't responsible for issues in the past. And it's not necessarily that I'm looking for companies to become great in the future, it's just that they're better than they currently are. So a good example of this in the portfolio today would be Wright. So it's a well-known company, it's been around for a long time, and it very much did sort of lose its way over a number of years despite still being the market leader. There is now a new management team who've taken over from the original founders of the business and really injected a new fresh lease of life into the company. And there's some very easy things to change. So for example, they still have 3 stores in Inverness. It's obviously a very small town, and they only have one, and they have no stores at all, in Liverpool. So clearly that was a poor historic capital allocation decision, and something which is reasonably easy to fix. Again, a refresh and a rebrand of the offer, the introduction of very basic things like interest-free credit, which most of the industry have been doing for 10 years or more, give you a strong impetus to improve that business. So it's that kind of internal change that is one of the things we look for. A second type of change would be the external change, or the industry change. And this is something I like to see where a supply side, particularly in an industry, is reducing. So maybe competitors go out of business, or you see a sort of a boring industry where people are looking to withdraw capital, and you have the potential to take market share and consolidate an industry. So a good example of this, something in the fund today, is DCC. They basically distribute solid fuel. It's a very boring business. It was traditionally done by the likes of BP and Shell. They were very inefficient at doing this, and they've consistently been selling off their assets. And DCC have been buying those assets, running them better, consolidating the industry. So they've been able to take share in what is a very, very boring industry, but they've been able to make very good returns from doing so, despite the fact there were a number of players that were making very poor returns and wanted to get out of that industry. So that's something I really like to see, where there is people actually thinking this is a bad industry, we want to get out, but a company can actually make that work in that industry. What's important though is just because a company is unloved, has been doing badly, and other investors aren't interested, that doesn't necessarily make it a special situation that has the potential to get into the fund. So very much my job is to sift through this market reject bin to really find sort of the uncovered gems in here, rather than things that actually are in there for good reason. I think one of the big things about companies that fall into this bin that I don't buy is where things aren't actually changing positively in the industry, or where balance sheets are stretched. And very much when you look at 3 companies here, which I think most people would agree are quite unloved, likes of Tesco, Glencore, Standard Chartered, clearly people are seeing big problems at those companies, and investors have been selling out. The issue is that supply is not yet reducing in these industries, particularly in UK supermarkets, where competitors online and then the discounters, Aldi and Lidl, are still adding space, so returns are still falling. And then also in each of these cases, the balance sheets of these companies are poor, so that there is debt and there are leases on the balance sheets here, and therefore when things are bad and there is a debt load, the potential to lose potentially all of your money is there. And I would very much steer clear of these type of situations unless I was confident that the balance sheet issues were getting sorted. In contrast, when you look at the 3 stocks in the fund today, which I think are still unloved, likes of Shell, Lloyds, Ultra Electronics, these have stronger balance sheets, that there is positive change and capital is being reduced, both in the oil space with capex going down, banking a big consolidation and a withdrawal of capital. And then in defence, it's both a improvement in the overall industry outlook because of the defence budgets, and then an ongoing, again, consolidation of the space where Ultra Electronics are buying up other lowly valued competitors. So I think positive change starting to happen in more solid business models there, and that's very much the sort of thing I look for in investing in special situations. Looking at the makeup of the fund, this slide goes on to talk about sort of when you buy special situations, sort of what you get. So it very much is a diversified fund. We have about 100 holdings today, and there is a big bias to smaller companies. So about 50% of the fund in companies sub £2 billion, another 50% in more large cap companies above £2 billion. And so I think if you are looking for these uncovered gems, you have a higher chance of finding them down the market cap spectrum because there's less analysis externally done on those type of companies. And in contrast, we have a very big analyst team at Fidelity addressing those opportunities. We have 40 people covering Europe, 5 of them dedicated to small cap, and also a US and emerging markets team based in London as well, which give great read through to some of the ideas. Additionally, I think it's quite important to have a diversity of sort of how far down the recovery track your ideas are in the fund, and that helps dampen volatility in the strategy. So I class every stock in the fund into a stage 1, 2 or 3 idea, and that very much reflects their movement through the recovery cycle. So how much have returns started to improve, where is the valuation versus history, and I very much buy the ideas in stage 1 and then they move through, and you're likely to see most of the fund in stage 1 and stage 2, with stage 3 being the ideas that are starting to reach their target prices. So just to sum up on this final slide, I think contrarian investing it gives you a good opportunity set to outperform the market because you're able to go against the herd, and only by going against the herd do I think you really find significant opportunity for outperformance. And I think that is something that Special Situations has demonstrated since its inception in 1979, obviously with Anthony Bolton originally, moving on to Sanjeev Shah before myself, and I think that this continues to be a very good vehicle for long-term capital growth and a very good place to put your pension savings. So that's it for the presentation proper. I'm very happy to answer any questions you may have. Unfortunately, I'm not going to be around for the Q&A session afterwards, so if there are any questions, please do them now. Thank you.
Just one quick one.
Okay.
This lady here, just one quick one, and then we'll have to move on, I'm afraid.
Just a very quick one, but £30 today doesn't mean anything like it did in the 1980s and 90s. If you ask the question saying 3,000, you might get a different answer.
Yeah, very much. Yeah, I suppose we obviously wanted to use the original experiment so that we could actually use the original outcomes. But you're right, maybe investors, once they think about larger sums, become more worried about loss aversion. And clearly in financial markets, we are dealing with significant sums, which may sort of lead to people taking those certain decisions.
Thank you very much indeed.
Thank you.